So we finally, did I mention finally, got our rate cut? Is it long overdue? Are we behind? Does anybody care? Everybody just is like, I want low rates and that's what I want. Let's just get this thing over with. Let's chop those rates. Let's get them down and let's start to move the housing market. Honestly, the $1 trillion question was not the rate cut because we were always going to get one. The $1 trillion question that everybody is really trying to figure out is, where do we land? Where do the feds want to land? Where could we land based on economy? I'll just be completely honest. How do I say this? I've said this on prior videos. Prior to me doing content, really studying data and understanding what I was talking about, most of the time I just think rates were going to come down just because I thought emotionally they should, or hey, I think they should because of law. And whatever I thought, really, when I look back, it's like, if I knew what I knew now, you would have clearly saw. We knew there was issues in 2008, obviously, like this didn't make sense, but you would have clearly saw that this is going to be a nightmare. You would have clearly saw, right? Even in 20, 21, 22, there's people that know that when rates were that low, we never thought they would go that high, but we clearly saw that there's going to be a change. We did talk about that. I talked about that a lot. Enjoy this while it's here, because rates are going to go back up. Thinking rates are going to go in the 5s, not into the 7s and 8s, and not shim the 8s and 9s. So most of my conversations, what most people really want, what they care about is, where is this plane going to land? Where are we ultimately going to be? And the reason why most people, I think, are asking that question is because whether they're buying a piece of property, it's their primary. Maybe they want to sell the property and trade up because they bought a condo, they bought a home. And over the last 5, 6, 7 years, well, maybe you got married. Well, maybe you had a lot of kids. Well, maybe you want to get out of the neighborhood you're in. You don't like it. Well. There's all these things, right? And so you're trying to plan, do I get out of this rate, this payment, and move on? Do I refi now, or do I wait one more year because it's not that big of a deal? Do I buy an investment property now because maybe it's less competition, I'm going to get a deal, and when rates are down, it's going to be harder because a lot more people are going to enter the game? Do I buy a primary now, or do I keep renting? What in the world do I do? Is really rates going down going to solve the house affordability problem? And honestly, there's just so many questions, but the one answer I keep coming back to is, when of these rates are going to come down. Because let's be honest, folks, these rates are really not going to solve all the issues out there. It's impossible. And yeah, when you have rates in the 2s and the 3s, 100% it pushed up real estate prices across the board. I'm sure there's people that you've read or seen that bought a bunch of real estate at the peak prices, at the lowest level of rates, locked it in, and maybe now they have to refi and now they're having problems. Or maybe now they bought a property, got a bridge loan, and now they're like, how the hell am I going to get out of here? So there's obviously many, many things going on out there. But the biggest thing that just the average general consensus mindset thought, what we all want to know, is where potentially could rates go? And from there, what should I do? Oh, and by the way, if we've never met, my name is Kenny Simpson. And if you're watching me, if it's your first time, I appreciate your watching. If you've been watching me, I really appreciate it. But if we've just met and maybe we've never talked, maybe we've never worked for, maybe this is the first video you're watching, and I hope you come back and watch more. I'm a mortgage broker by choice. I've been doing this over 20 years. Yep, I am definitely aging myself. I helped over 5,000 customers, funded billions of dollars of loans, and I make videos like this to help educate you. Because maybe you're buying your first home or buying your first investment property, or you're watching this because you want to refi, and you're really just trying to get some honest feedback, no salesy BS. Well, that's kind of what I am. I'm very transparent. I'm very to the point. And I like to call myself more an advisor because I feel like every day of my life, I'm advising people on things. And what I like to put it is, I don't really want to tell you what you should do or shouldn't do. I just want to tell you maybe what other people are doing, or what potentially could happen, or this or that. Basically, at the end of the day, I'm just here to help educate. I'm here to give options. I'm here to answer questions. And ultimately, you're going to have to make the best decision for you, or your family, for your investments, for your future. But Anyways, that's my spiel. And now we're going to get back to the video. But if you wanted to chat with me, if I could help you out, feel free to reach out to me anytime. Love to chat. And there's many ways to find me. But if you typed in Google Kenny Simpson Mortgage and you found me, go to my website, book an appointment, text me, DM me, whatever it is. Love to chat. Anyways, back to the video. So as I was saying is, it's really, really important for a lot of people to know where we're going. If obviously we all knew where we're going, we write a book that says this is where we're going, and that'd be the end of it, right? So today, what I want to focus on is whether it's the feds, whether it's other people, where ultimately, let's talk about one thing, is the Fed's fund rate where it will land. Remember, the Fed's fund rate is tied to HELOCs for business, personal, maybe credit cards, things like that. The Fed does not necessarily have the ability to just bring long-term rates down tomorrow when they cut rates. They could do it through other instruments, which we're going to get into. So what the feds do focus on is cutting those Fed fund rates. And those Fed fund rates do lower or raise rates. They also signal what the feds are thinking. Obviously, folks, if the feds are cutting rates, let's back the train up like they did in COVID, bring them down to zero, buy mortgage-backed securities, bring those interest rates down to low levels. And just like Mr. Powell said, that's what helped and kept the real estate market alive. And I guess what? I truly believe with him. I do call him Big Mouth Powell as a joke. Obviously, Powell does not really speak much. You've seen him outside. He's a very kind of quiet, chill dude. I don't know him, but that's based on what I hear, see, and obviously he gets up and speaks. And why I call him a big mouth is anybody in the Fed, that position I'm going to, because what you might not know and what I've learned by shooting content, researching, watching, reading, and I was a little bit shocked when I found this out, but the 10-year Treasury is what we watch here at the Simpson team. And most people that are in the mortgage industry watch the 10-year Treasury. So every day we wake up, where's the 10-year Treasury out? And then based on the Treasury, based on spreads, which I've been over a gazillion times, there's a 10-year Treasury, there's a 30-year fix, and then there's spreads. If depending on where the spread is where you're going to dictate interest rate. It's very simple, but it's very complicated, but that's the basis. So if you want to know where our interest rate's at, you could simply log into like the CNBC or go into Google and type in 10-year Treasury and you can watch that. So one day if you wake up and it's 4%, and the next day you wake up and it's 4.25%, that means interest rates went up. One day you wake up, it's 4%. Another day you wake up, it's 3.85. That typically means interest rates go down. Also the spreads. The spreads is not as easy to find. That's something that changes a lot slower. And we're going to go into that. But the spreads were blown out in 22, 23. That means they were the widest they've been in a long time. They're over 3%. And today those spreads sit around let's just call it 2.30, a difference of 70 basis points. So today, the rate you're getting quoted, let's say you got quoted at 6.375, no points on a refi. Maybe it could be 6%, whatever your scenario is. Keep in mind that those spreads today, if they were as high as they were, that interest rate would have been 8%. So a lot of which brought the rates up was the spreads. Why did the spreads go up? Well, the spreads go up when, let's just call it the market, it loses confidence, meaning that inflation's high, meaning that the feds have to raise rates, meaning that there's bank failures. There's things like that in the system that are not good. That basically spreads go up because those investors want more money. Maybe they think they're also going to get screwed when there's a refi, and then they want rates higher to protect themselves for losses in the future, especially when you're servicing loans. I don't want to get too much in the weeds because I'll confuse you, but spreads are in the middle. So now the spreads have come down to 230. It's helped interest rates. Let's focus on the spreads quickly. So that way I can kind of tell you where those should go, where those live. And then we're going to go to the Fed's fund rate. And then we're going to kind of back this into what potentially could happen depending on where the Fed's fund rate is, depending on where the spreads are, depending on where the market's at. And hopefully we can try to land the plane for you folks that are watching this. So that way it will help you whether you're going to refi now, whether you're going to refi in 3 months, 6 months, 9 months, 12 months, 24 months, whatever it is, because we can't predict the future. All we can do is watch data. And based on data, we can kind of determine what the feds are going to do. But back to my statement really quick before I dive into the spreads. As I mentioned, the feds have a lot of influence on the 10-year Treasury, which I was shocked based on what they say and do, which is a big deal. That's why I call him Big Mouth Powell, that whatever they say and do, remember that 10-year Treasury, that is kind of a forward-looking index. So it's kind of looking 6 months forward, let's say, and then they come back. So if the feds are hawkish, meaning inflation's out of control, meaning I got to slow the train down, and that's what they're saying is we're going to raise rates over the next 2 years, 1 year. You and I know rates are going up. You and I know the 10-year treasury is going up, and that's not going to be good for rates. But if we come in a moment like we did in COVID, where we're like, holy shit, the world's coming to an end, we got to cut rates, and the Fed's going to go into turn on that money printer and fire that sucker up and red line it, then that 10-year treasury is going to come down. But that influence, that talk what the Feds does, 70 to 75% of what the 10-year treasury, the barometer that we use in our industry, is manipulated. It's not manipulated because they don't go in there and do it, but let's say is influence. Let's use that word, influence, by what the Feds say and do. So do you understand when the Feds are looking at bullshit data and it's wrong and they're making rate cut decisions or rate hike decisions or what they say towards the future and they're wrong, that means they potentially are having rates too high, keeping rates flat, or potentially just like they did after COVID, they kept rates way too low for way too long. Even though you and I enjoyed it, it was marvelous, it was wonderful, because a lot of you that might be watching this are the ones, they're the lucky ones. Maybe you're the real lucky ones where you paid off your house and you're the 42% in America. You didn't know that, did you? Maybe you're the ones that are the 75% of you that have a 4% or less, or the 33% of you that have a 3% or less, and you are sitting there and you're happy in one way, but you're also like, I wish I could take this mortgage with me, because you would go buy another house. If rates were low, you might go refi, cash out, consolidate debt, build an ADU, go buy another property, maybe rehab your property, whatever it is. And so there's the other people that bought in the last 2-3 years, rates are higher and they're trying to figure out what they're going to do. There's a lot of people that feel trapped. There's a lot of people that are also renting right now and that didn't buy, and they're kicking themselves. And they said, I'm going to wait. And they're like, damn it, I could have bought the house, been at 2-3%, lived there forever. Wouldn't matter if values go up and down. Because remember, when you're at 2% and you can afford your payment and values go up and down, you're going to stay there for 20-30 years. If we're talking about a home, not an investment, just a home, could be investment, it's really not going to matter. Because it's your home. It's where you live. It's where you make memories. It's where you wake up every day, where you go to sleep, where you cook, where you have friends over, family, all that stuff. It's much more emotional than an investment. So a lot of people feel trapped in many different areas. And so they want to know, am I going to get untrapped? Am I going to feel some pain relief here? And that's the $1 trillion question. So when I talk about the spreads, let's talk about the spreads. We're going to move on. I know I'm kind of a little bit all over, but I'm trying to get you guys to understand how these things work, who's trapped, and why it really matters. So when it comes to spreads, you might think, wow, we come down 70 basis points, we must be there, must be good. That answer is no. The spreads typically, historically, if you look over the last 50 years, live between 160 and 180. When do they go up? When do they go down? Well, they go up times like after 2008, times like after COVID's done and we printed too much money. And then they start coming down when times start to get rough or normal. And what does that spread focus on? That spread could be dictated by the economy, by rates, by what the Fed say, by GDP, jobs report, the whole thing, right? It's just confidence up, confidence down. So if that spread, let's just say goes to 180 and we're at 230, if you can do the math, that's 50 more basis points. Let's just say we go there. So the rate that I just told you, it's 6.375 with 0 points on your scenario. The rate could be 6%. It depends on the scenario, what you're doing. If you're refi, purchasing, LTV, FICO, all that, rates are not going to be the same. But I mean, I price out scenarios that are 6.375. I've priced out scenarios that are 6% because somebody has a 60% LTV. The point is that depending on where your scenario is, depending on where you land, that rate, if the spreads were normal, would be 50%, 50 basis points lower, potentially 70 basis points, but let's just call it 50. So let's say it's 6.375 is 5.875 tomorrow. Wow, crazy. What else would bring the interest rates down? Well, the 10-year treasury. Okay, great. Now, how does the 10-year treasury got to get down from where it is here? It can be manipulated. So you understand the spreads and what brings the spreads down. Now we're going to go on the 10-year treasury. So the 10-year treasury obviously is going to go down by a few reasons. Depends on, I remember I told you 70 to 75% is influenced by what? The Feds. Influenced by what? The Feds. Influenced by what? The Feds. So I'm trying to teach you guys how this stuff works. So if you know that now and I know that, that means whatever the Feds do, whatever the Feds say, whatever the Feds think, whatever they put out there into the world, whether they're right or wrong, is going to positively or negatively affect the 10-year treasury. So if I'm at 5.875, I get my spreads down. The 10-year treasury is sitting at where it is today at 4.1 and some change, okay? Now, how do I get rates down? So today we're just talking about spreads and the 10-year treasury. Well, If I'm just started and I turn back on the rate cutter, right? I'm starting to slice and dice, and I'm Powell, and I say I'm going to cut 2 more times this year, and maybe next year before he leaves, there's a potential 2 more cuts. Okay, so if he cuts 50 more basis points this year, are we 100% certain that the interest rates will go down on the long term? No, we are not. Okay. So why is that? And here's where a lot of people get this mixed up. So pay attention to this again. I'm going to repeat what I just said. If Powell cuts 50 basis points, he already told us he's going to cut 50 basis points. How do we know if rates will come down or not? We don't know. As we've been saying, it could be baked in the cake. The rates you see today on the 10-year Treasury could already be baking in the 50 basis point. And you're sitting there going, but wait a minute. But if he's going to cut, why does it not affect long-term rates? And like I told you guys minutes ago, the 10-year Treasury, think of it. If it's a group of people, bond buyers, whoever, they are looking out 6 months. So is it built in? It could be. Is it not built in? We just don't know. Is he really going to cut 2 more times? We don't know. So where could it change? Number one, it could change if we don't know. Powell might cut 25 and 25. If the jobs market continues to get worse, he might have to go 50-50, 50-25. That's what not the market thinks. The market probably right now thinks a quarter. If he has to cut 50-50, 50-25, that would push more pressure down to bring the 10-year Treasury down. Try not to get in the weeds here. So just very simple. Just because the Feds cut 50 basis points in the next 2 more meetings, or when they do it, does not mean the 10-year Treasury will come down by 50 basis points. Could it? Absolutely. Should it? Can't answer the question because who knows. So to wrap this video up and to answer the $1 trillion question that you all want is, Kenny, where do we think this will land? Because I need to make some decisions. Do I refi now? Do I wait? What do I do? If the Fed's fund rate at the end of this game, at the end of this juncture, where they think ultimately employment lands, inflation lands, GDP lands, where they think the economy will settle in, they think they will end up at a 3% Fed's fund rate. That means that today, if they're at 4.25, that is 1.25% lower on their interest rate that they can cut. One last thing I want to mention is that when it comes to the 10-year Treasury, then how did interest rates drop so much in 2020, 2021? Because didn't the Feds influence it? And the answer is yes, big time, because they went and they bought mortgage-backed securities and treasuries, and they brought the interest rates down along with other people, pension funds, hedge funds, world countries. So can they manipulate long-term rates? Yes, but it's not by cutting rates. It's by buying mortgage-backed securities, printing money, buying them, bringing it down. So if the jobs market, the economy falls off a cliff tomorrow and they need to bring rates down tomorrow, the 10-year might fall on its own, or they could just fire up that printing press and go and buy it bounce. Buy down and bring that sucker down. They can get it down quick, fast, overnight. If we know the Fed's fund rate is going to end up at 3%, and let's say that's where we land up. When we land there, who the hell knows? Let's just say we land there by the end of next year, just to pick a date. Cool. Where, let's say the spreads, remember the spreads? Let's say they land at 180. We're already there. So we already have that built in. So today, right now, you're at 5.875, no points, or maybe 5.5, no points. We don't know. Let's just say the rates came down 0.5 point. You woke up tomorrow, the spreads are normal. Woo! We're celebrating. We're fired up. Okay. Now, we're going to cut 1.25 over the next, year and a half, year and a quarter, whatever you want to call it. Where does that land the 10-year Treasury? That's going to determine where's inflation, where's the jobs market, where's consumer confidence, what's the global risk, what's the government debt situation, right? What's the strength of the dollar? All these things are going to matter. Who's buying our, is anybody buying our debt? Like there's so many factors, but let's just say it's 3%. The spreads are there. And let's say the 10-year Treasury could land between 3.25 and 3.75. Let's just say I meet you in the middle. It lands at 350 at the end of this. We got a 350 10-year Treasury and we've got a 180 spread. Okay. Are we on the same page? So 180 plus 350. So let's just do the math. If I just told you you're at 6.375 and we go down to the normal spread, you're at 5.875. So if the 10-year Treasury is at 4.1 and we go to 350, that's 60 more basis points. So 5.875 minus 60 basis points puts you exactly somewhere around 5.125, 5.25. And depending on your scenario, remember I told you You could have a scenario that's a quarter, half a point lower. So at the end of this, you could, yes, have loan interest rates on a 30-year fixed conventional, depending on the scenario, probably in the high 4s to low 5s. You could have FHA and VA in the high 4s to mid 4s, okay? Jumbo, same thing. ARMs, same thing. Commercial, same thing. How do we get there? I just explained it to you. That is how you get there. When will we get there? That's the question that nobody on this planet can answer. And that's what you guys are trying to figure out. And that's what I'm trying to tell you. So to wrap this up, if you're looking to refi, if you're not sure what you should do, if you're confused, I understand it's very tough. But what I would say over the next 12 months, 18 months, 24 months, depending on the data, depending on the jobs market, depending on inflation, depending on globally, if there's any crazy stuff, whatever it is, if the data continues to get weaker and slower, the economy's slowing, inflation is maybe not taking off crazy, but if the job market starts falling off a cliff, they will cut faster. So if we get normal spreads and we get the 10-year down, you're going to see rates in the 5s and 4s. It's just going to happen. This is not emotional. This is no BS. This is just looking at the data. Could rates not get there? Sure. Could they go lower? Absolutely. What would make them go lower is I just told you. When you go back to COVID, and things were really, really bad, or up to 2008, and they have to buy mortgage-backed securities or bring rates down for stimulate the economy, they can do so. They can put money in your pocket. They can buy rates down. They can give money to the banks. They can do a lot of different things. If rates went below what I told you, basically what I'm telling you is what they're telling us, that there's a crisis. There's something that's not good. So one side's not good. The other side, rates going down. Sure, it's good temporarily. And that's kind of where we're going to live. I hope that helped. Try not to confuse you. So where would rates go? I'm going to tell you here. If I'm going to continue to follow the trends and the data is going to follow, we all think will happen is we'll kind of level into the spot where inflation will kind of hopefully eventually cool down, where the jobs market might slow down. The economy is going to sink into this new spot after we come out of being locked down, not spending money and saving money and paying down our credit cards, to coming out and spending our savings and racking up the credit cards, and things got more expensive. We are now settling into, the hangover, the economy after the craziness we just went through. And so ultimately, if we do kind of land where the Fed predicts or other economists predict or hedge funds or whoever predicts, if we land around the 3%, 3.25% Fed's fund rate, and everything kind of gets there, and the 10-year Treasury is somewhere between where I told you, you can kind of predict where rates are going to be. It depends on your scenario. It depends on that. So hopefully that helps. If you do have a scenario and you want to price me out, the best thing would do is kenny@simpson-team.com. Go email me there. It's just I need information like, is this primary, is it investment? What's your FICO? What's your name? What do you owe? What's the value? What are you trying to do? Cash out, rate, term. Just give me some information, or just say, Kenny, I want to refi. What are the questions? We'll send you back. We can get you a quick quote out quickly, see if it makes sense, and then, there. And then so what do you do? That's really based on the numbers. I mean, if you can save $1,000 right now or $500, and maybe you may pay 0 points, a minimal closing cost, that's what you do. If you're going to save $1,000, but it's going to cost you an arm and a leg, and then you might be able to save that by waiting, then you got to rethink about what's best for you and your family. So I can't answer that for you. I can just give you the information. So hopefully this video helped. Thanks again for watching. Share this with somebody. If you have questions, let me know. If there's anything else you'd ever want me to talk about, let me know, because I always need stuff to shoot videos. Because look, I shoot this stuff. It's a lot of work. I got to put it together. I got to entertain you. I would also try to educate you. So this one wasn't sexy, was entertaining, but I guarantee 1, 2, 3, 5 of you, whoever watches this, maybe only one, actually learn something, and hope you kind of understand what you're planning for. So over the next year or two, rates should come down. There should be substantial opportunity to refi, buy, and hopefully we will all be able to take advantage of that. So thanks so much. Talk to you soon.